Welcome to Killik & Co.'s podcast from Tuesday, the 28th of May. US and UK holidays and the equity markets were closed on Monday, but it followed a much more volatile week last week for stock markets around the world, led by Japan, where we saw a 10% intraday turnaround, having been up 3%. The Nikkei ended up down 7% at the early part of last week and carried on in pretty volatile form for the rest of the session of the week. And of course what we also had last week was a discussion from Ben Bernanke, the Fed governor. He held his meeting following the FOMC minutes, which was initially greeted with some enthusiasm by markets, but the devil as always in the detail, and there were discussions there about tapering QE programs in the US. Indeed, some members again commenting that they would like to see that happen from June 2013, and it's clearly the fact that QE has been such a major stimulant to equity markets. We've discussed this on numerous occasions in the past, but the depression of yields in some other asset classes making equity yields look relatively attractive and squeezing equity prices higher. So of course any discussion that QE program is going to reverse in the foreseeable future leads one to conclude that yields will rise and therefore equity markets may look less attractive. From my point of view, I think every month we will have to get used to conversations that will discuss the potential exiting of the QE program, but that I don't believe it will come to real action. I think that the economic data will still stand sort of clear water between what is required to be achieved for the QE programs to reduce, and therefore I expect that the foot will remain pretty hard on the accelerator for QE programs, not just in the US but increasingly in Europe and Japan as well, and same here in the UK with the appointment of the new Mark Carney. So we did see equities fall last week. The FTSE was down around 3% on the course of the week. The gains this year obviously were at one point up around 16%, reducing those gains to 13%. And as we approach the start of a new week, we've already seen European markets that were open on Monday trending higher, and therefore the FTSE is already starting with some pretty significant gains across the board and recovering at least half of those falls that were seen last week. So let's just take a look at the week ahead. Given that it is a 4-day week, the calendar does look a lot thinner. There are a couple of items of macro data which I think is worth observing. Obviously US consumer confidence on Tuesday, but I'm interested more in European data at the moment, particularly in Germany. The German data has been quite weak of late, and we have German unemployment reports and CPI data coming out on Wednesday. Just remember that the ECB being the last to cut rates, with an indication they'll be watching data points very closely for further stimulus easing in Europe at the moment. So of course any news out from Germany I think is going to be more eagerly watched at the moment. So a few trading updates on Thursday. Kingfisher Group, which will give a little bit of an indication of the recovering home DIY market in the UK and also in France. Let's just take a look at some of the charts that are important at the moment. This is the chart of the Nikkei, obviously the chart that we have shown on numerous occasions in the past few weeks, which has shown a sort of fairly sort of unbroken ride to the upside. But it's the fall last week which has shown the first determined effort to bring some sort of balance back to the Japanese market. And of course that move last week just taking the top off, but as I say, causing a little bit of stir across the rest of the markets. Here in the UK, we didn't go up quite so far, so of course we haven't fallen so far. It was about a 3% drop, and as you can see that sort of tick up in the markets this morning means that the uptrend for me remains very firmly intact, certainly in the sort of European markets. In terms of the currencies, whilst this looks like a fairly steady chart between the euro and the dollar, it is one chart that I'm looking for potentially a little bit more volatility coming through, because we've got this sort of push-pull situation now with the eurozone weakening further in terms of economic growth, sitting some way beyond some way away from where they need to be, and any sort of further weakening from here, I think, will require further stimulus, which indeed may lower the value of the currency relative to the dollar. And of course, the dollar, when you start talking about exiting from QE programs, or at least tapering the quantity of stimulus at the moment, even if it's not carried through, it's dollar strengthening. So whilst we have seen some sort of steadiness there at the moment, maybe some further data over the course of the next 2 or 3 weeks might just bring that currency into a little bit more volatility. Of course, a weakening euro currency at the moment is what Europe may need at the moment to continue the stimulus of export-led growth in Europe, where the domestic demand is faltering quite badly at the moment. In terms of a couple of stocks, I just wanted to highlight the continuing trend looking for good earnings yield situations, not necessarily dividend yields, but good earnings yields relative to bonds and other asset classes. I've been highlighting companies like Glaxo, for example, that have nudged through £18 this morning. Its year-to-date performance up 35%. Still doesn't look expensive based upon the sort of valuation metrics that I'm looking at relative to other asset classes at the moment. So there's still that share price remaining sort of pretty much untroubled by last week's 3% fall. And another stock that is continuing to sort of bounce close towards the high is Vodafone. Last week's results from Vodafone, I think, pleased on a number of levels, despite the faltering demand in Europe, which is costing them certainly some scope for growth. Around 20% of their business is based in southern Europe, and that demand is falling pretty much off a cliff at the moment. But the rest of the business seems to be in pretty rude health. They are managing their cost base accordingly, and it meant that they were able to upgrade their guidance for cash flow for 2013 and 14. So still looks very much a valuation play and just nudging around 200 pence.